While every fixed income investor presumably understands that the surge higher in interest rates that we've seen in recent years provides opportunities to earn a higher yield, we think that many investors fail to appreciate the role that higher yields can also play in helping to keep the total return of bond portfolios positive, even if rates tick higher again in the future. That's because the total return for either a bond or a portfolio of bonds is the positive or negative change in the price of securities plus the current yield. As an example, in order for a bond or a bond portfolio yielding 5% to experience a negative total return, the bond's price would need to fall by more than 5%. In short, a higher yield can help to keep total returns positive even in the event that higher interest rates push bond prices lower in the future. This is a substantial change, as for most of the past 15 years, short-term interest rates in the U.S. remained mired at around 0%. And in a bizarre twist, many global bonds literally spend time paying negative yields. For savers and investors, particularly income-oriented investors, that is fortunately no longer the case. The painful global bear market in debt securities caused by the historic surge in interest rates has arguably also created a favorable environment for income-oriented investors who have cash to put to work today. This is in sharp contrast to just a few years ago when yields were so low that only modest moves higher in interest rates would have caused negative total returns in an income portfolio. In contrast, in addition to today's income investors benefiting from higher current cash flow, they also benefit from the fact that yields are so high that it would take a significant move higher in interest rates before any decline in debt prices would be sufficient to create negative total returns in a bond portfolio. While this is no guarantee that an income investor will not lose money, the risk-adjusted return potential of bonds and notes, all other things being equal, now appears slanted significantly in the favor of income investors for the first time in literally years. That perspective is further reinforced by looking at today's debt markets on an inflation-adjusted basis. That's a net of inflation basis after inflation is taken out. This measure is very important as inflation erodes the purchasing power of the income produced by bonds, bills, and notes. As you can see, real or inflation-adjusted yields are the highest that they have been in many years. While there's no guarantee of investing success, we do believe that many of the strong headwinds faced by income investors over recent years are now at least modest tailwinds. That is something to at least consider for the owners of the more than $6 trillion of money currently sitting in money market accounts, particularly as money market yields are likely to decline once the Fed starts cutting short-term rates. Food for thought. Thank you very much.